Now, in recent weeks there have been calls for those on variable rate mortgages to be up in arms about the amount they are paying. One senior politician, Fianna Fáil finance spokesperson Michael McGrath, called it discrimination and said those across Europe on similar mortgages were paying up to 2% less. In a moment, our panel in studio will discuss this, but first our economics editor Paul Colgan joins us live from AIB headquarters in Ballsbridge. Paul, good evening.
Well, the cost of borrowing for the country and by extension its banks has never been lower. But if you're a variable rate mortgage customer in this country, you won't really be seeing any benefit at the moment. They're not very happy. All the main banks are charging over 4% at present. And it's a big constituency of people. And as you say, Chris, it has become a political issue over the past few weeks. So with this in mind, in the first of our new regular feature, Real Money, I've been looking at the mortgage rate debate. There's 300,000 of you out there, variable rate mortgage holders. As the banks look to rebuild their balance sheets and make up for all those bad loans they extended, the squeeze has been applied on the poor variable customer. Conor McNally and his wife Tanya are permanent TSB customers on a variable rate of 4.5%. It was not so long ago as high as 6.5%. Small numbers, though, have big consequences.
It increased our mortgage payment by nearly 30%, and that took a huge amount of money out of our family budget that we had to do without other things to cover this expense.
Conor says the size of the monthly repayments became too much and the family fell into arrears. They have since come to an arrangement to deal with that, but he feels that because permanent TSB is suffering significant losses on its low-paying tracker mortgages, families like his are being asked to pick up the tab.
We know the bank is making losses, but that does not give them any right to continue gouging people to try and make up those losses.
If the interest rates had stayed at around 3.5% for longer and hadn't escalated as high as they did, do you think you would have still fallen into arrears, that you would have still fallen behind on the mortgage?
No, I wouldn't have, because there's a big difference in the monthly payment.
The average variable rate mortgage in Ireland is about 4.25%. Now compare that to Europe, where it's more like 2.5%, and it seems like Ireland is very much the poor man of Europe when it comes to variable rate mortgages. But what does that mean in real money? Well, it means if you have a mortgage of around €250,000, in Europe you're paying just over €6,000 a year in interest on that mortgage. But in Ireland you're paying well over €10,000 a year, a difference of over €4,000 in the year. It has never cost the banks less to borrow money on the markets, and this begs the question, why do they continue to charge their variable customers so much? The main European central bank rate is practically 0%, free money in other words. People on tracker mortgages will know all about this. Tracker mortgages strictly follow the ECB rate, and many of those customers must say thankful prayers every evening for that being the case.
You're probably talking somewhere in the region of €450 to €500 a month difference between somebody on a tracker rate with a margin of 1%, the example I've given earlier, or 4.5% as an average standard variable rate now. You're talking €450 to €500 a month. It's an incredible difference.
So that's about €6,000 a year?
Yeah, approximately.
You could spend that money on
a hell of a lot of things you can do. Irish banks are clamouring to return to profitability. They've got significant arrears in their old loan books, and they're doing everything they can to possibly achieve that. And clearly the most profitable avenue for a bank is through their mortgage interest rates. Now, permanent TSB said this evening that they're not gouging their customers. They point out that the bank is still loss-making, and that they say when they return to profitability they hope to be able to pass that on to their variable rate customers. Another issue which may be debated in studio is that about the tracker mortgages. They undoubtedly saved a lot of people during the downturn, people who otherwise might not have been able to pay their mortgages every month. They benefited from those low rates. The point is, those rates won't last forever. What happens when they go back up?
All right, Paul Colgan at AIB for us tonight. Paul, thanks for that. In studio with me now are Brendan Burgess from askaboutmoney.com and Karl Deeter of the Irish Mortgage Brokers Association. Thank you both for being here tonight. Brendan, it's interesting Paul used the word gouging. A politician used that, a senior politician last week, to describe what the banks are doing with variable customers. And as Paul told us, 300,000 of them out there. Do you have any sympathy for them? For the customers, not the banks.
I'm trying to think, who am I supposed to have sympathy with here? Absolutely, yeah. I mean, I would tend to use the word fleecing. The average cost of funds for the banks in Ireland is just above 1%, about 1.1% at the moment, and they're lending out at 4.2% on average. So there's a big difference there, over 3%, and there is just no grounds for that margin. There may be reasons for Irish mortgages being more expensive than mortgages in other parts of the EU, but there should not be that difference, and that's having a real effect on people like Conor, whom you showed in your clip.
Would you have much hope, or would you be holding out any hope for the report that Michael Noonan asked the central bank governor for about this a couple of weeks ago, or is that just a time-buying exercise?
Not really, because back in August, when the central bank said the average rate in Ireland was 3.2%, which was a little bit dearer than the rest of Europe, I contacted the central bank and said, where are you getting these figures from? The average rate's 4.5%. And they tried to persuade me that the average rate was 3.2%. And it was only after I went for them and pushed them and that I discovered they were including tracker rates in their calculation of new business. So whether that was incompetence on their part or whether there was some sort of conspiracy, and I'm not a conspiracy theorist, but I can't understand how they produced figures to say the average rate was 3.2% when it was over 1% higher than that. So I think the central bank's priority is to protect the margins of the banks. So they're not really out there to protect consumers. But then there are other people who should be involved. Where's the Competition and Consumer Protection Commission in all this? Brian Hayes and Michael McGrath wrote to them separately, and they said, well, we do not think this would be a good use of our resources to investigate it. I mean, some people will argue that the higher rates are justified. Well, I haven't seen that justification, and I'd like to see that justification.
Karl Deeter, this adds up over the lifetime of a mortgage, a 30-year mortgage. I mean, it adds up hugely. And the variable and trackers is a debate that has been had before, and people say to them, well, you made your choice. But when variable mortgage holders at the high rate at the moment see new customers being offered products that would make them €1,000 better off a year, over a 30-year mortgage, that's 30 grand to a family. This all adds up. Do you have sympathy for the people on over 4%?
I suppose I would have a very targeted sympathy, and I would probably describe it more as empathy rather than sympathy, because they entered into a financial transaction of their own volition. So I would empathise with people who are stuck in negative equity and can't switch. But for a lot of people with variable rates, they represent older loans, and they actually could switch. And if their own inertia is causing them to pay more, well, then I really see it as a subject of their own responsibility to fix that.
Well, tell us the options. So of the 300,000, what options to switch are there?
Well, you can switch with the likes of KBC, who will even pay your legal fees. And they have some of the best market-leading rates in the country. Not only that, the other thing that's being lost in this conversation is that rates have started to fall already. That trend has been underway for a while. You saw in the clip that the people were paying 6.5% and they're down below 4.5% now. In December, AIB cut rates for everybody, including their old customers and their new, by 25 basis points. They're now at 4.1, not 4.5. And the actual trend...
But what's the European rate? What are they borrowing at, Karl?
Well, you see, if you want to look at Europe, you've got to look at Europe. And by that, I mean, look at what they pay depositors in Europe, 0. In Ireland, depositors are still looking for 2%. So what I'm saying is that it's a host of factors that play into our mortgage rates. But the more important thing is there's two big indicators at the moment that are being missed out. First is that fixed rates are lower than variable rates. That's a surefire sign that variable rates are set to drop. The second thing is that the cost of money in Europe, you look at this thing called a yield curve, and you normally expect the price to be higher in the future. It's called a contango line. What you see is that for 7 years into the future, the price of money is negative. That's a big sign that borrowing rates are coming down, and out to 30 years it's less than 1%.
But did Brendan not hit the nail on the head with the central bank? Because in many ways it is both poacher and gamekeeper, because it is supposed to have this merit of customer protection, but at the same time Ireland needs to sell, particularly AIB, for as good a price as Ireland can get.
Customer protection doesn't mean that you set prices. It means you protect people from contracts which are fundamentally unjust. The variable rate doesn't have anything fundamentally unjust in it. What it does have is a higher price than someone on a tracker. But the important thing to on that facet of it is to realise the central bank has no jurisdiction. They've said that. The central bank governor has said that not only do they have no jurisdiction, but that he doesn't want to get involved in setting prices, and that lowering prices might discourage competition. So Michael Noonan has no jurisdiction. So all these people who have no power...
Are you saying leave it? There is no remedy for those 300,000 people?
It's coming down in spite of anything we do. And someone somewhere is going to jump up and down and claim victory for a trend that began 2 years ago and that is set to continue for the next 2 years.
Brendan, your response to that?
No, I can't accept that. The market is fundamentally unfair. I mean, yes, people entered into a contract for a standard variable rate, but the situation at the moment is that we have 5 providers and they're not really competing. And I'm the biggest believer in the free market and keep the government and to keep the central bank out of regulating things. But when you have a market where there is no competition, then unfortunately you've got to interfere. And I do believe, as a very last resort, legislation should now be brought in, and I would call for legislation to be brought in to say that the maximum interest that they can charge, and make it a fairly generous maximum, 2% above the cost of funds, something like that, that this legislation will be brought in, and we'd say to the banks, sorry, you cannot gouge or fleece customers anymore. There's going to be a restriction. Now, I think if you did that before the legislation came into the Dáil, I think you'd find the banks would bring the rates down to fairer rates. I mean, Karl says people can switch, but like the cheapest rate at the moment is 3.55%. That's still a good 1%, 1.5% dearer than the average rate available, and that's the cheapest rate. So, and not everyone can switch. It's not just negative equity. People are in Connor is in positive equity. He can't switch because he's a bad credit record, because he lost his job during the crisis.
I gave the first word to yourself, Brendan. I'll give the last one to Karl. Just your response to that. Brendan has talked about a new law which would cap at 2% above Europe what the banks can charge. Would it work?
It's pretty incredible. What you're saying is to legislate for the reintroduction of forced trackers, that you can only go a certain margin above cost of funds. That would actually be disastrous, and I don't think it would benefit. The whole thing is, if we were charging all these miraculously high prices, why isn't half of Europe clamouring to lend to Irish people? They're not. There's more to the Irish market than just the fact that our variable rates are high, and you have to take it in the whole rather than just in a particular issue, and realise that there's so many other things at play, and anyone in officialdom, consumers protection, central bank, Department of Finance, they're all shying away for this for very good reason.
Karl Deeter of Irish Mortgage Brokers and Brendan Burgess of AskAboutMoney.com. Thank you both for your time. Now, still ahead on tonight's Ireland Live at 10, we're going to have